Good morning, ladies and gentlemen. We've had a pretty exciting week, and at the moment, we would argue that there is only one chart that matters, and that is that of the 5-year note yield in the States. Just as we thought last week, it has arrived at the crucial juncture, which is around 1.875 in yield, 187.5%. This is the level that it has rejected many times in the past, and where it actually started the year in 2016. If we end up with a candle like this for the year, it is going to be very bullish in terms of yields for next year at some stage. We really need to see some retracement down towards the 161, 165 yield level to be able to counter some of the extreme bullishness in yields which is evident from this chart. On the weeklies, this is seen even better. 118.00 basically is the line in the sand. If we now break at any stage below here, and you can see how we are outside of all the Bollinger Bands, so that would argue for a period of decent consolidation and moves back up to 119.25, 119.5. We will be in a world of hurt for all other asset classes. I think we can exclude looking at other charts like the 10-year or the 30-year, simply because the belly of the curve, the 5-year note, is going to be the one that gives you the biggest indication of overall trend of interest rates. We would argue that now the 2-year note is going to trade roughly with the short-term interest rates, and we already know that the Fed isn't likely to hike many times in the next few months, since they will continue hiking at their glacial pace. The 30-year note is probably, and here we have the 30-year note. The 30-year note is probably anchored to where they think long-term inflation can be, which is roughly around the 3% area. This is in price, and in terms of yield, we are roughly at 3%, as we can see, and we have all these downward sloping for decades yield levels that we have to break through. So we would argue that 30-year is definitely going to be much less of an indicator of trend, and so is the 10-year rather than the 5-year. The 10-year also is at very interesting levels that it has spiked at many times in the past. And again, we are at the same levels as where we opened the year. It is going to be very interesting to see whether 5s and 10s close at these levels for the year. If they close lower, around the 210 level, we have some hope of this not being extremely bearish and probably building some sort of inverse head and shoulders in this area. But if we now continue and break up, there's going to be absolute murder in various different asset classes like the dollar and gold. Euro USD is the one that actually is going to give us the biggest bang for the buck in terms of interest rate differentials, because interest rates in the EU bloc are actually going nowhere. They're being held by the ECB, and the results of the Italian referendum are unlikely to change ECB policy. So at the moment, the greatest danger is actually in Euro USD. You can see that we have actually returned to the levels at the beginning of the year. At the beginning of the year, we were trading at roughly around 108. We have returned to roughly below those levels, and we are now trying to decide the next big move. If the 5 and 10-year note, and specifically the 5-year note, now start breaking above the yield levels we just showed you, the trend in the Euro USD is going to be very much defined, and a test of this trend line is almost certain. This trend line would come down somewhere just above parity at the moment, but then after a brief bounce from those levels, we would have thought that this trend line gives way and we could have prices somewhere in the low 90s. So as you can see, we are at very, very important levels, and all the next moves are going to be defined by the 5-year note and the 10-year note in the States. You can forget about bunds, you can forget about JGBs. If you actually have a look at the market, this is a daily, but even on the weeklies it's even more apparent. You can see what the yen has done against all forecasts, simply because the 10-year note in the JGBs is being held at zero by the Bank of Japan, and will be held at zero for the foreseeable future, and that has enabled a huge spike up in dollar yen. Well, the same thing, we argue, could easily happen in Euro USD, and we could have the move that we just suggested. Gold is at exactly the same situation. It has returned to just above where it was at the beginning of the year. This 1179 level is absolutely crucial. Let's see if next week we can bounce a little bit for 3-4 weeks before trying the downside again, which is the absolute reverse of that 5-year note chart that we showed you. Whichever way we slice and dice this, the 5-year note is going to be the one that decides the direction for gold and for the dollar for the foreseeable future. Any break of the 118 level and we could see further cascades downwards in gold and Euro USD. Moving on to US equities, this market has done absolutely nothing wrong, and I wouldn't see any reason at all to sell it. After the break, after Trump, it consolidated in a very nice range, broke up, and has since held every single attempt at pushing it lower. It is above all moving averages. There is absolutely nothing bearish about this chart and no reason whatsoever to short it. The only question is, where do you get out of your longs? At what level is this market too expensive? And you might want to look at some alternative market for positioning rather than ES. The same story absolutely is true for TF, for the Russell. It is even more beautiful in terms of holding all the moving averages. It is right at the highs. It certainly is overbought, but the market is always overbought when it's in trend. It's not something that you have to short because of. It's just something that gives you an indication that it's going to be very tough to to buy at these levels, but there again, the market is not taking any prisoners and not allowing anybody dips to buy, which is an indication of strength. There is absolutely no reason to sell this chart. All we are going to do is look for levels where the market becomes too expensive and then get out and wait for a dip to rebuy. In Europe, this is a chart of the weekly DAX cash. We have done very little over the past several months. We are at the same level that we have been for 3 months or so. But that has allowed all these moving averages on the weeklies to start moving upwards, and we would argue that the next significant move is going to be up towards the 12,000 level, which could easily happen on a breakdown of the Euro USD down into the 90s. So we are looking for an opportunity to shift some of our longs ES into longs DAX, which is a much cheaper level of multiple than the ES. At the moment, there is no reason to do that. We could easily have several more weeks of wiggle before the final breakup, but we don't see any reason to be short of it. At the moment, it's a trading market, but one which is developing strong signs of trend and imminent trend break. And when we say imminent, a month to 2 months, these are weekly charts, and therefore you have to allow them time to work. Looking at fundamental valuations in the States, we are rapidly approaching the time 17 Blue Angel in the S&Ps, which has held it for many years. With that level comes in around the 2230, 2240 level, slightly upward sloping. So we would argue that that is the place where you replace your longs ES with longs in other markets, or certainly get out of longs in ES, because the upside is very limited and the risk reward no longer favors being long. The other sectors also indicate that the index has not very much further to go on the upside. Consumer discretionary is almost tapped out. Consumer staples, while the bonds are in the state that they're in, are unlikely to recover very much. And energy is a complete mess still. Financials have reached almost the 14 times line. They might have another 2 or 3% in them, but then they become far too expensive and risk reward favors trading to sideways. Healthcare is becoming a mess and probably will be trading between 900 and 800 for the foreseeable future, so that is not going to give very much support to ES. And the one that is really rather overbought is the industrials. It's now reaching levels that it hasn't seen since the 1990s. So certainly we see very little potential upside help from the industrials, and they're actually more likely to give up 5% than appreciate 5% from these levels. All of which tells us that the overall index of the S&P 500, when it reaches the 2230, 2240 level, is actually probably tapped out, and it's time to get out of that and look for something else to trade from the long side. We're not saying that the ES is going to suffer any huge falls once it reaches the 2230, 2240 level. It's just that the valuations will have reached such levels that risk reward no longer indicates it's prudent to be long. So our biases for next week are more or less unchanged. In bunds, we think long-term volatility on upward squeezes has to be bought, because at some stage there will be an attack on the bunds. Is that imminent? No, we don't think so. That's why we're saying long-term volatility. We're talking about 3 to 6 months at least so sometime towards the end of the first to the second quarter of next year. In the ES, we don't want to be long above 22.35. The Russell is still our preferred instrument because it trades much better than the ES, which makes perfect sense. In the 30-year note TLT, if there are squeezes up to the 127.50 critical level, we want to be sellers of those. Our 5-year note position at the moment is the equivalent of being also long gold and also long currencies, and therefore we definitely don't want to be playing a bounce in those because we have enough exposure to that trade, but we will be looking for places to actually reverse our position, because our long is only for the very short term as a very good level that we got in because of the risk reward of the chart. Do we think fundamentally that interest rates in the States will now decline? Well, probably not. We think there are probably going to be some more movement on the upside in those interest rates, and therefore we think there is going to be very much higher volatility in the dollar complex, especially in Euro USD, which has a lot of cross currents in it, including the Italian referendum. We can't see any reason to be short of volatility in Euro USD. Maybe for the very short term, 2 or 3 weeks, nothing much is going to happen, but at some stage there's going to be an explosion from the 106 level, either towards 110, 112, or down to parity, and we are quite convinced of that. And it all is a factor of the 5-year note mainly and the 10-year note in the States, because we think that bonds, JGBs, all other fixed income is going to be held in a very tight range by the central banks. The one that they can't control is the 5-year note, and the 10-year note is going to be very difficult for them to do that, and all big moves are going to start in the 5-year note and 10-year note and then spill out to gold and to currencies. Those are our biases for next week. Again, have a very good week, good luck, and we'll be with you all the time tweeting away. Thank you so much.